This episode of Talk Your Book is proudly brought to you by Spirit Technology Solutions. If you do business, do it with Spirit.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Marcus Burns, thanks very much for making your Talk Your Book debut. Really excited to sit down and have a conversation with you. I thought we'd just start by you walking us through Spheria Asset Management and how you guys look to invest.
Thanks, Chris. Well, thanks for having me. Look, we've been around for about 5 and a bit years now. The team was carved out of Schroders, where we ran small microcaps. And what's our difference? I guess Matt and myself, the co-founder, and Adam, the three of us who came from Schroders together, have lived through a couple of crises. So we came through the GFC, we came through the Asian crisis previously, and I guess that kind of formed a lot of where we are today. And so really, there's three things we think we do broadly differently from some of our peers. We think cash flow is king, even today when cash isn't really valued as such. We believe in valuations, so we do think long-term, economic gravity applies, and valuations, discount rates kind of make sense, and the market sifts through and finds levels that's supported by valuation. And then finally, we actually like to try and minimize risks. We play in micros and small caps. We think that lowly geared balance sheets and cash flow help minimize that risk. And so over the long run, that gives us and our clients a better return. That's probably how to summarize this in 3 points. And
what stock did you want to talk us through today?
Well, Chris, I picked IOOF, IFL. It's not a particularly popular stock right now, but I just thought it's going through an interesting transformation, and it'd be worthwhile engaging on that topic and talking about why we think it's interesting.
Yeah, so maybe start with the top-down view for IOOF for viewers that aren't familiar with it. What's their business model and what do they do?
Yeah, sure. So IOOF has gone through a bit of a transformation over the last 2 or 3 years, and now looking forward, what it is effectively a platform for financial advisors to use. Platform is something that advisors use to put clients' money through, that measures, taxes, gathers all the information from different sources, and makes asset allocation, planning, and taxes information much easier for them to assess and organise. So it's brought up a wealth platform from ANZ and then one from NAB MLC, which had just completed about a month and a half ago. So it's really now an agglomeration of 3 platforms, some financial planning, and some funds management in one business. That's kind of the business model at the moment.
And we'll dig a bit deeper into the numbers later on, but I guess the sexy part of the business, if you like, is their platforms, or that's the consensus view at least. And I guess the funds management view is viewed by some as being a drag on the stock. When you compare the multiples paid for, say, Hub24 or Net Wealth compared to IOOF, they're really significantly different. And I guess that's largely due to the messier breakdown of the IOOF business compared to the platform businesses where they just do the one thing. Do you want to maybe extrapolate on that, and if you agree, and what does that look like to you?
I do agree. I mean, I think you're right. I think the consensus is right. The sexiest part of the business is the platforms, and that's the high repeatability, low capex, reasonably low capex, good margin, good free cash flow part of the business. Then there's financial planning, which they sort of need, if you like, to have the funds. So the financial planners go out there, detail products and ideas and services to clients, and then they put some, not all of their money on the IOOF platforms, the 3 large ones they have now. But they can still use external platforms as well. So their internal platforms are competing with external platforms. There's no compulsion that they use internal ones. They've got to stand up in their own right. But the financial planning businesses, has gone through a lot of changes in Australia over the last 4 or 5 years. And I think those regs have made it quite difficult for many people to make money, including IOOF. So part of their planning groups are losing money. But they see that sort of loss as a necessary cost, I guess, to keep the funds on the platform side. And then the third bit is they've got some actual funds management business, or some stakes in some fund managers that particularly they're inheriting with MLC. If you look at the history of the last 2 or 3 years, have sold off stakes in their other funds. So I suspect that they might look to divest that over time and realize some gains there. But I think what's interesting is that you're right. People look at Net Wealth and Hub and Premium, which are all sort of pure play platforms, and go, these are incredible businesses. They're more like technology businesses, SaaS, all the buzzwords. But what I find interesting is that Hub and Net Wealth really gained over the last 3 or 4 years as the big banks, the big 4, look to shut down and reduce their financial advice exposure. And so advisors were leaving those platforms, leaving the banks, taking their clients and their money out of the big 4 platforms and looking for independent platforms, of which Hub and Net Wealth are the leading ones in terms of capability. But given that pretty much all the big four banks have now divested their either their financial planning businesses and or their platforms, IOOF really is considered independent. It's not really part of a big bank. So even though the two of the three platforms came from banks, not really big bank platforms, they actually are independent. So I'd be surprised if you see the same level of advisors kind of leaving their platform once that's all bedded down and settled down that we've seen compared to what we've seen historically.
And it's the fact that they, even pre the Royal Commission, am I right that they're allowed to invest in funds that were outside of the platform compared to, say, the AMP model where it was all vertically integrated? Is that accurate to how they were operating, and they escaped more reputational damage because of that?
Chris, I think so. I mean, it's that's going back way before I started looking at the company seriously. I think that probably is the case. But I mean, all the financial advisors have, within the big books, typically got some level of remediation provisions against them. So IOOF has, I can't remember, something like 500-600 advisors on their platform, actually possibly more than that. And they put aside a provision for any mis-selling advice that might have gone on historically. I think it's $200 million or so of provision for that. They're kind of paying that out currently, but the books they're buying from, or the businesses they're buying from, both NAB and ANZ, have that risk sterilised. So that cost, if you like, is sterilised with ANZ and MLC. So they get the advisors, but they don't have the historical risk. And I think that all of them now have got significantly better compliance in place and better incentives in place, so that the mis-selling risk is materially reduced. I mean, I'm not saying it goes away completely. It's always part of the risk with being in the business, but compared to what it was historically, it's definitely, I believe, been mitigated. Time will tell.
And in terms of macro factors providing a tailwind for the stock, we've got super contributions increasing from 9% to 10%, I think up to 12% in 2025. And we've got an aging demographic as well at a time when people look to commit more money to their super as retirement gets closer. Are they a couple of the macro tailwinds that you think are providing, some potential blue sky for IOOF?
Chris, yeah, I mean, yes, you're right. There's a lot of funds, a lot of money going to superannuation. I mean, the risk, I guess, is that some of that money dribbles down to SMSFs and self-managed forms, et cetera, not necessarily through intermediated platforms, et cetera, where these guys are strong. So it's positive tailwind, but there's some other trends in the industry that are going on that don't necessarily support platform growth. I guess our thesis there is that, there's so much IOOF can ring out in terms of costs in the background. I mean, they're putting together two different platforms. Even those platforms had multiple legacy platforms. So rather than, there's sort of three main ones that came across, but I think MLC has got four or five platforms that they'll shrink down. ANZ had 3 or 4 that they're shrinking down to 1 or 2 over time. And even IOOF had 1 or 2 that's now shrinking down to 1. So you've got multiple angles kind of contracting down to hopefully 3 and eventually 1 or 2 in the long run. And when you're dropping off, you can imagine these things, these are 20, 30-year-old legacy platforms, right? I mean, think green screen, think IBM mainframe machines, or whatever they all was 20 years ago. And maintaining those platforms with poor technology is really difficult. So as they get funds off those and clients off those, recycle them back to newer, lighter platforms, there's a significant amount of cost saving to eke out as well. So, really our thesis is, it's actually hard for advisors to move platform. Once you've got clients on a platform, you can move them off, but it's incredibly time consuming. And we've had discussions with advisors who say, look, you can move, but it takes 12 months to move. So we can do nothing else for 12 months and move our clients off a platform. But then what's the point of being a business? We've got to make right revenue. So as long as they do a reasonably good job, and as I said before, the platforms are open so clients can leave and choose other ones if they're not competitive, we feel there's a pretty good proposition for people to stay with IOOF. And that's really what we're banking on medium term.
And talk me through the numbers. What's their market cap? What free cash flow are they spinning out?
Yeah, well, as I mentioned earlier, we are free cash flow junkies. We find it hard to value things that are not on free cash flow. So if you look at let's say the last 10 years, the average free cash flow from IOOF has been about 88 to 90% of their earnings. So that is what percentage of their actual net profit in accounting terms is converted to free cash flow. Has been very high. And that's really because it is a cash generative business. It doesn't require a lot of reinvestment. Although they are putting money back into the platform, it's typically expensed rather than capitalized. So we like that angle to it. It's got a market cap of around about 2.7 billion today. It has some gearing because it bought MLC with debt and equity. But the gearing relative to its earnings, we think is pretty under control. And we just think that, you're trading on probably something like 10 times EBIT if you look forward 1 year, P of about 13 or so. It should be yielding 4.5% fully franked of that order. And if you think that, these cost savings come through from the platforms, you should be getting, double-digit earnings growth. So all those things to us look pretty attractive relative to other stocks we're seeing in the market now that we think is pretty expensive.
And do you think there'll be any top line growth over the next 1 to 2 years, or will the increase in earnings come from costs out?
Well, I think the reported growth will be there because obviously they're integrating MLC, which they just bought in, I think it was end of May, got finally approved. So there'll be acquisition growth. Underlying, I suspect you'll probably see a bit of contraction in that revenue line. And there's two things going on there. One is there's been a bit of repricing in the platform market. So the BTs, etc., have been pretty aggressive in trying to, in terms of pricing down, to try and keep their book. Hub and Net Wealth have been getting in there aggressively, trying to win business by cutting prices to get people across. So there has been some pricing pressure in the marketplace, but IOOF has gone through with its legacy platforms a fair bit of repricing already. So a lot of that's already in the market, but I think there might be a little bit of that just washing through. And there probably is a tail of some of the financial advisors that they brought across from MLC and possibly ANZ just going through that adjustment phase of, do we stay with the new group, or do we look to leave? And as that beds down over the next 12 months, I think you find a core of advisors and a core farm that sticks there and is pretty attractive. But yeah, so reported earnings will be up, reported numbers will be up, but I think underlying there'll be a modest contraction in their revenue and EBITDA if you took out the acquisitions.
And when do you think their balance sheet would be in a place to look at newer acquisitions, and what do you think they could potentially be?
Oh, great question, Chris. I don't think there's going to be a lot of further M&A for a period of time. I think, if anything, it could be some divestments. As I said earlier on, they've bought some wealth managers with MLC, and I don't know, but my sense is they might look to sell some of those off. That'll realize some decent cash, and they'll look to reduce debt. They've just done 3 major deals in the last 4 years. I think they've got a handful, frankly. And also, I think they're so big now. They've got roughly 200 billion of funds under advice in the platform market. That's probably in total about 850, call it. So, they're roughly 25, 22, 23, 24% of the market overall. I think it might be a bit hard for them to buy anything else. So they probably don't need to, frankly. It's not what we think is a short-term issue.
Is overseas expansion unlikely?
Yes, I think so. Typically, these platforms are quite tailored to domestic markets, whether you're looking at the UK or Australia or the US. And so, I don't think there's an urgent rush to go overseas, but can be pleasantly surprised.
Great. Well, I've heard of free cash flow before, and dividends in other stocks that other people own. It's not something I come across in a lot of the stocks I own, Marcus. But really appreciate you coming on and talking us through IOOF, and I think it's a great one to watch.
Okay, great. Chris, thanks for having us.
Thanks, mate. This episode of Talk Your Book is proudly brought to you by Spirit Technology Solutions. If you do business, do it with Spirit. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.